2 years ago, your weekly grocery bill was $200. Today, that same cart of food costs you $280. You see headlines and news reports celebrating that inflation is falling. But when you look at your bank account, when you pay your rent, when you fill up your car, your wallet tells a very different story. So, who should you believe, the official data or the reality of your daily life? The truth is, you're both right. And understanding why is the key to navigating the new economic world we live in. The confusion comes from a simple misunderstanding. Inflation measures speed, not level. Imagine you're driving down the highway at 100 kilometers per hour. You ease your foot off the gas and slow down to 40. You are still moving forward at a significant speed. You haven't stopped or gone in reverse. When you hear inflation is falling, it's like the car slowing down. The rate of price increases is getting slower, but prices are still increasing. The massive price spike we all felt has already happened. That new, higher price level is the new baseline. To understand how we got here, and why prices aren't going back, we need to examine the series of shocks that fractured our global economy. For decades, the world operated on a hyper-efficient model called just-in-time manufacturing. Companies kept minimal inventory to save on storage costs, relying on a perfectly timed global ballet of parts and products. Its greatest strength, efficiency, was also its fatal flaw. It had no resilience. When the COVID-19 pandemic hit, this fragile system shattered. A single factory shutdown in one country could halt an entire assembly line on the other side of the world. Ports became gridlocked with ships waiting to unload. This created a bidding war for space, and the cost to ship a single container from Asia to the US. But then, a curious thing happened. Even after the ports cleared and supply chains began to function again, prices didn't fall back to their old levels. Why? Because businesses made a critical discovery. Consumers, having been forced to adjust, would now tolerate these higher prices. Economists call this phenomenon sticky prices. Once prices move up, they are very resistant to moving down. New contracts get negotiated based on the new cost of living. Commercial and residential rent agreements are reset at higher rates. Employees, seeing their own costs rise, demand higher wages, which in turn locks in higher labor costs for businesses. The entire cost structure of the economy essentially recalibrates and locks in at a higher plateau. For prices to actually fall, it would require a painful economic recession, a period of lower wages, reduced corporate profits, and economic contraction. And no system, and no government, willingly chooses that path. Layered on top of this is a powerful, invisible force: human expectation. It creates a feedback loop that can drive prices even higher. If businesses expect their own costs to rise in the future, they will raise their prices today to protect their margins. As a consumer, if you expect the price of a car or a new appliance to be higher in 6 months, you're more likely to buy it now. This collective rush to buy now pulls future demand into the present, creating a surge that, ironically, pushes prices up even faster. This cycle, where rising wages push up prices and rising prices push up wage demands, is known as a wage-price spiral. It becomes a self-fulfilling prophecy, driven by the shared belief that things will only get more expensive. So, while an official report might state that inflation has cooled to 3%, our memories are long. We don't feel the 3% increase. We feel the cumulative effect of all the increases that came before it. We remember the 12% jump in food costs, the 9% spike in fuel, the sudden and shocking rent increase. Our psychological trust in the idea of stable, predictable prices has been broken. And once that trust is broken, it is incredibly difficult to restore. We become more sensitive to price changes and more fearful of future increases, reinforcing the cycle of expectation. What we have witnessed is likely not a temporary blip, but a permanent structural reset of the global economy. For 40 years, the world prioritized maximum efficiency above all else. That era is over. The new priority is resilience. Companies like Apple are actively diversifying their suppliers, moving parts of their iPhone production from China to countries like India and Vietnam. This strategy, known as nearshoring or friendshoring, makes supply chains more robust against single-point failures. But it also comes at a cost. New factories must be built, and the massive economies of scale found in a single production hub are lost. This shift towards resilience, combined with the sustained high cost of energy and persistent demands for higher wages, is building the foundation for a permanently higher price base for the goods and services we all rely on. This new reality means that waiting for prices to go back to normal is likely a losing strategy. The system has fundamentally shifted. The most successful individuals and families are not waiting, they are adapting. They are actively upskilling and learning new trades to increase their earning power in a more competitive market. They are investing differently, moving assets into places that can better hedge against inflation. They are fundamentally changing their spending patterns, making more conscious decisions about where their money goes. They are seeking out new and diverse income streams, understanding that relying on a single paycheck is riskier than ever before. Inflation falling is not the end of the story. It is the calm after the initial surge. The great wave has passed, but it has permanently redrawn the shoreline. The economic landscape is different now, and the people who take the time to understand this fundamental shift, the ones who adapt to the new terrain instead of waiting for the old one to return, are the ones who will not only survive, but find new ways to stay ahead.